Hey, Corey, what's happening, man? Thank you so much for joining me again. Again, everybody, Gary Massa here with Massa & Associates here in San Diego, and here with Corey Peterson of Kahuna Investments, the big Kahuna himself. And again, Corey, thank you so much for joining us from your family vacation out in Florida today because, again, we really appreciate all the information. So thank you.
Yeah, I'm excited to be here, and I got my rent stew hat on because it's always we're always trying to collect some of that.
That is very true. And I still have my sweatshirt. My kids love it and they take it. I get questions about it all the time when I'm running on the beach. So diving right in here, so this was a two-part series. Last week, we kind of talked about, just the general, what is an apartment syndication and how can people invest in apartment buildings without spending millions of their own money, right? There's a couple of different options. They could buy it themselves. They can do a joint venture, or they could do a syndication and allowing them to spend, portions of the money of what it would cost for them to buy it outright, which is a great opportunity for a lot of investors like myself. So today I wanted to dive more into we're going to dive into a case study of a building that I'm invested into, and obviously you're operating that building as well. So we'll talk about a little bit about that, but also let's dive into like the general, like what is the deal, like, how many people were involved, how does it really happen, the process even leading up to getting the transaction or the deal going, again, going into the case study, and then we'll just get some advice from you on what people should do if they're looking to invest. So you ready?
Yeah, I'm ready, buddy.
All right, let's dive into it. So first of all, can you walk me through the general specific, or not the specific, but the general points of, of putting a deal together? Like how many investors typically go into it, and the roles that everybody might serve. And we talked about transaction classes as well. So maybe you can shed some light on what that really looks like going into a deal.
Yeah, so typically it seems like, it all depends on your minimum, but we usually have $100,000 minimum investment. And if you've got a $3 to $5 million investment that you're raising capital for, it's going to be between 30, maybe 35 investors. It seems like between 30 and 35 seems like no matter what the size of my raise seems to be what I get almost always. And that's, people with hundreds, 300s, 500s. There's kind of a mixed bag, and it's usually a bell curve, right?
Right.
A lot of people come in with hundreds, and then once their first people come in with hundreds, their first time, once they understand it, they tend to give $200 to $300, $400, $500,000 increments, right?
Okay.
Their role, though, really coming in is just limited partners, meaning they're not responsible for the day-to-day, making any decisions on the asset. They have no voting rights. What they're really doing is it's just kind of like buying mutual funds. They're going to buy into our investment, and I'm going to be the fund manager. I'm going to be running this asset, this apartment, to make sure it's profitable. Now, I tend to do that with me. I usually create a team or a group on what I call the general partnership side, my side of the equation. So we have usually A shares and B shares. A shares are where my limited partner shares are, and B shares are ownership partner shares, which I usually have probably two other operators with me to share the workload, right?
Right.
Now, in the limited partner shares, we typically have three classes, A-1, A-2, and A-3. And here's the real simple reason for it, Gary, is we usually pay, on average, between what we call a 6 and 6, 6 and 6 deal, where it's half of our investment. We pay a 6% pref as we go along. That's the cash flow, and we pay that out to our investors. It's 6% annually, but it's really, if you give us $100,000, it's $1,500 a quarter. That's what we typically do. But then after investors have they've said, hey, Corey, I've got $300,000. Can I get paid more? And so we thought about that. We said, well, the answer is yes. So we created a 6 and 8% class. And what that all means, so 6 and 6 is a 12% annualized return through the whole entirety of the investment year over year.
Right.
6 and 8 is 14. And so there's a price break, and that's usually at around $300K to get that 2 percentage points more on the deal. And then we usually have a third price break at $500,000 where someone will get 6 and 10 or 16% total return year after year on their investment. And so those three share classes are A-1, A-3, A-3, but it gives the reward to investors that want to invest more of their money.
Right. Well, and it's kind of more risk, more reward, right? But there's two things I kind of wanted to clarify and ask the question just from that, and just making sure the clarification of, the 6% pref, like, and you said was paid quarterly in the example, $1,500 a quarter on $100,000. But then the additional 6% or 8 or 10 in the other examples you used is paid when the investment terminates, right? Like when you sell the building at the end of the, for example, 5-year term or whatever that is, then they're paid a lump sum. Is that correct?
That's exactly it, Gary. So usually there's an event that's going to happen. It could be sell. It could be a refi where we use the appraisal value of the asset, right? To then essentially do what's called a capital call or a buyout option where we will, or not a capital call, but a call option where we will buy out everybody's share. And to do that, we have to pay them their 6% pref and that 6% annualized for every year. So it's a big dump of money at the end, and that's the sell event. And that usually makes sense for most people.
Absolutely. And so the other term you're using right now for people who may not be aware is the term pref, right? So there's two different investment opportunities. Basically, there's the preferred return, and I'm blanking on the second return option where maybe explain the difference between the both. I'll let you do that.
Yeah. So the pref means you get it no matter what, right? So, and I say no matter what, as long as the deal doesn't go south for whatever reason, right? We're still in real estate. There's still a million things that can go wrong. Typically not so much in apartments. That's why I like it.
Right.
But as we're going, that pref is, this is the money you owe me. And it's the first dip in the bucket. In other words, the first people that get paid are the pref holders, and they have to get that pref hit. So I'll give you an example. Let's say we had a deal. We gave you a 6% pref, but for some reason, a COVID happened, right? And maybe that 1 year during COVID, we couldn't make any payments. You're still owed the pref. So even if we have to push it back towards either future operating years or whatever and start making a prepayment, we still owe you that pref and we have to pay you back. Or when we sell the asset, we still have to catch up the pref before we make anybody else's their next part of that waterfall, which is the sell distribution. And
Right.
so, in other words, it's just a good way. Most operators are going to try to pay you the pref based on cash flow. That's how we base ours on, and that's typically what happens unless there's a world pandemic called COVID that would prevent where you're like, hey, listen, we need to keep our cash here to make sure we survive.
Right.
But the pref is always still owed.
Well, and from what I understand, it's a less risky type of investment into apartment buildings because, again, like you said, it's formulated to always get paid back versus the other. If you're all just partners with no pref return, the return percentages may be a little bit higher, but yet you share in a lot of the risk to where if the building doesn't make any money, neither do you. Correct.
Yes. There's other ways. They'll say, hey, listen, our property didn't make any money, or it's a 50-50 split. And so with the owner, with the like someone like me, and they're like, hey, listen, at the end of the day, this thing only made 6%. So you're going to get 3% and the owner's going to take 3%.
Right.
Well, that doesn't seem fair, at least. And that's why we make our structure that we want to make sure our investors get paid first. First dibs out of the profit.
Right. And
then I'm last.
It makes it more of a, I don't know, I guess accountability for the operators, right? So people are saying, look, you're offering, like you're basically as the operator putting up returns that you're very confident about. So you have to make this work out because I'm going to get paid no matter what. You might not, right? So I think that really speaks a lot about your.
You got to be, as the operator, the syndicator really should be taking their money last, right? So, and I think that's the right way to do it.
No, I agree. So we've been talking about the operator as well. So like, again, one reason why a lot of people may want to get into apartment syndications, because maybe they've like had a bunch of investment properties and individual rentals where they've, like we talked about last week, they're just dealing with tenants, all the problems that happen, and they're the ones that have to deal with it. So going into a situation like this, it's kind of a hands-off deal. That's like, you're really doing, or the operator rather, is really doing all of the work while they get to maintain the investment. So talk about what the operator's role is, just so people have a clarity when you keep talking about the operator.
Yeah, so operator would be me. And my goal is to then hire the right management company, the right team members, and get the right financing, put the deal together, raise the exact right amount of capital, watch our capital improvement projects. In other words, make sure we don't spend too much money and repair just what's needed. And to make sure that we're always keeping an eye on the P&L, the profit and loss statement, the place where we make money.
That's right.
And so my job is to manage that very carefully, and we watch it like a hawk, and to really just implement the business plan. Typically, when we come and we're actually buying the property and we're going to give it to the investors to invest in, we've done an insane amount of due diligence to proof up the deal. In other words, we've already made sure the juice was worth the squeeze before we were going to offer it to our investors. So we usually have done a forensic audit, and we can talk a little bit more about that, but like, we do an insane amount of pre-work before we would even offer it up to investors, so they can know that, hey, okay, we have a game plan. We understand what the game plan is. We understand where the value's at. Like, you as the investor, you need to have that enough information to clearly see it yourself, not just to trust on blind faith. Bad idea, bro. Right. But when a syndicator gives you that much information, it gives you, I think what happens is your confidence level goes up significantly as compared to the stock market, where we're on a roller coaster, heading to who knows where.
Right. Well, I mean, you kind of brought up points in my next question about the process and leading up to the, to the investment opportunity for which an investor might be able to introduce it to. So like, what goes into that calculation? Like, location, economy, it's not just, from what I understand, you guys aren't just grabbing any opportunity and throwing it out there. Like you said, there's due diligence that's already been done and already been vetted by the time any investor sees the opportunity, right?
Yeah, Gary, we kiss a lot of frogs. I mean, we kiss a lot of frogs, and we'll continue to do it. So typically, we've got markets that we are looking for apartments. So currently, right now, we like San Antonio, Oklahoma City. We like Atlanta. We got a couple of student housing properties that we like in certain areas in the Midwest and the South, and so those are the markets that we typically look. So we look at the market first, and what we're looking for is job creation. Where are the jobs coming, right? And going and looking for that. So we look at the marketplace first. Once we know our market, then it's an exhaustive effort to find as many deals possible. And we get those mainly from brokers. So brokers give us potentials, and then we have to then crunch the numbers. The great thing about commercial real estate is, Gary, it's all about the numbers, and the numbers never lie.
That's right.
And so we then go get as much data, and we put it through a process, and it lets us know if we have a potential deal. At that point, we're like, okay, we think it's a potential deal. Let's go drive or fly to the asset and then do what's called the site visit. Now, at the site visit, Gary, we're already there. Our job, honestly, is to kill the deal. My team knows we go to kill deals. Like, we're king slayers. We have big axes, and because that's typically what happens. Like, we spend a lot of money to go fly and bring the team, and after a day, we're like, nope, this one didn't work. But we have to do that, right? So, and we're very conservative in that process, because our job is to find needles in the haystack, and all we have to do is find 3 or 4 $10, $15, $20 million deals a year, Gary, and then we're doing damn well, in our opinion.
Right. And I mean, and again, that's the point, that like, it's your job to bring back to the investors something that's really going to work out well over time. So then they refer, they, continue to invest more. And so obviously that's why you spend so much time and energy doing that. Not that you're just bringing up any investment.
No,
That
and the other part is I want to sleep at night, right?
That's
So
true.
this is what I've learned. In raising, last year we raised over, I think, $30 million of private equity, right? Of capital. And Corey's decided a long time ago that he has to sleep like a baby. Meaning, and the only way Corey does that is by being very conservative, understanding his comps, understanding his business plan and his people, to where when because listen, 10, 20 million dollars on top of your back could be exhausting and keep you up and make you not sleep at all. And
Yeah.
so I've learned in this business is to be conservative all the way through, kill a lot of deals. So when you find one, then you get to do the happy dance because
Yeah.
you've stayed true to the process all the way through.
That's right. That's right. Okay, let's move into kind of dive into the palms, right? So again, just so everybody knows, there's certain things that we can and can't say because of SEC regulations and whatnot. But what we really want to talk about with this one is like what the problem was, like why this was a good deal that caught your attention, how that was basically solved, and then what it's doing now, right? And this is kind of the example of like, a great opportunity that turned even better. You know what I mean? And again, just kind of shows people the stages of the opportunity. So tell us about the building really quickly, and then what the problems were when it was first acquired.
Yeah. So this property was brought to me actually by another group, and I was just going to be the sponsor. And then what I found out as I was going through my due diligence process was they were going to overpay for it. And so I had to back out. The deal didn't end up going down. And so I picked it back up from the seller for almost $1 million less because they were really wanted to sell. And here's why they wanted to sell. And sometimes understanding the opportunity. So again, Yuma is a very migrant town. It's one of the agricultural hubs, lettuce and things like that. So this property had a lot of what's called corporate leases. And to the extent where I think half of them were corporate leases. And that's great because they paid a lot of money, but they also brought in a lot of people, a lot of wear and tear. And honestly, what happened in the summertime is there's no agriculture going on in Yuma in the summer. It's hot as Hades.
Yeah.
Right. So that whole tenant base leaves, and so does the income. And so the property was just suffering from a lack of consistent income. And when it's not consistent, it's very hard to get, or easy to get off track. And that's what the seller had done, is she probably spent some money that she probably shouldn't have. And then she got to where she was in kind of a bad spot. So that was the opportunity. So we asked ourselves, we're like, how big is Yuma, the MSA? We're like, man, it's a pretty good size. I mean, you've got a base, you've got agriculture, you've got the hospital there. I mean, it's a pretty decent hub. Yeah. We're like, is there, and we only have 154 beds, I think, right? So we're like, can we find 154 people that just live here and like just want to rent like normal tenants and get rid of the corporate units? Because it's very consistent. And honestly, the banks don't like it either.
Yeah.
And so, and that's what we did. We made the commitment to that next summer. We didn't renew we renewed very little, like 5% maybe.
Right.
And it took us some time. Remember, you were right there when we were going through. I was like, guys, because when that income came off, remember, us like, here's the income's cut off, it's gone, summer's here.
Yeah.
But here's what we're going to do. Here's how we're going to fix it. And it took us a minute to do it. But by the end of the year, we almost had it completely done, to where we had rented out units to just the normal residents that lived in the city.
Right.
So by doing that, so here's the difference. There was monthly income was around 130, 135 with all the corporate units. And that would be considered really, really good. But in the summer, it was like $85,000 in total income. Well, that discrepancy is quite a bit. It's actually huge. And so we are currently now at, I think, 130, 135 with just regular tenants. So
Right.
in less than a year and a half, 2 years, we've already hit that chasm, and and the reason, and then, so because of that, the bank, we had a what's called a bridge loan when we first started. And the problem with the bridge is it's usually typically a little higher rental rate, right? Like it was like 6%.
Right.
We refied, Gary, because once we fixed that income stream, we went from a 6% loan to 3.25 or something like that with a Freddie Mac loan, 15 years, fixed at 3.5, and 5 years of interest only. And so it was like turning on a cash box, right? Our payment went from like $47,000 to 23 or something like that. And
Right.
it was already, and now we are in the income. So it became a cash cow. It's right now making almost $90,000 of NOI every month with a $23,000 payment to the bank. So we're almost netting
Right.
75K. It's a
Yeah. No,
beautiful thing.
I mean, and that's awesome. And then, so basically, you identified that there was a mismanagement of the building, basically, right? And
Mhm.
maybe some mismanagement of the funds. Being able to switch that around, and then really evolve the debt service to really add more value to it, and then talk to us about, like, so I know going into it, part of the upside was, improvements around the building, right? Exterior, interior, common areas and whatever the case, normal stuff that you would do to just make it prettier and try to get rents up a little bit. But there's another thing that we just realized coming out of COVID, and I don't want to spoil, I want you to talk about it. But in terms of the research that you did, the testing that we did on improving the units further to up the rents.
Yeah, so we started looking around in Yuma and said, "Hey, there's no new construction going on. There is a nice clientele that wants a little bit nicer, more luxury type of apartment complex, like with hard surfaces, nice cabinets, the newer stuff, not 1980s that Formica stuff that when you put water onto it just bends and folds, right?"
Right.
So our question was, how much would it take to really update this interior unit, 2 bedroom, 2 bath, to make it really nice with hard surfaces like granite or some type of Corian or something like that, new cabinets, new appliances, LVT flooring, new carpet, two-tone paint, right? So we found out that the cost is around 10 grand. So we're like, okay, well, that's all right, but how much could we rent it for? And so this is what we started to formulate, and we actually pre-leased or rented it without even finishing. We've not even finished the construction on this, but
Right.
we rented it for $170 more already.
Right.
Pre-lease. The girls signed the lease without even seeing the finishes.
That's
But
awesome.
that's what she wants. So if that's the case, so we're getting like $170 more a bed. So now we've done the math, and we're like, okay, it's going to take if we did every unit, how much would it take? It's like 150 or 1.5 million. Now we won't probably do every unit. We'll do about 75%. We got to leave some upside for the next guy to make. But by doing that, and truthfully, we can do it mainly through cash flow in a 3-year process, 3 or 4 year process. We may need some starting capital to start it, but at the end of the day, we'll spend about a $1.5 million, probably a bit less, and make about a $3.5 million or $4 million difference in value because we're going to raise the rents that much per door.
Right. Right. And again, just going back to the great thing about apartments and scale, every dollar that you raise it equals, more in value, because the valuation is based on your operating income, not necessarily the comps, right? That does
Correct.
factor into it, but
Yeah, it's really about like what's your NOI? How much income can you create when you directly affect the investment NOI, the money it makes? That's how investors buy properties, commercial properties. They could care less about what the neighbor's doing across the street as long as you have history and a proven track record of getting it on your property. So we
right.
already know there's a market for this product, in Yuma because no one else has it. They want an updated interior, and they're willing to pay for it. And there's enough demographics of the people that can afford it. So, give the market what it wants. And listen, the market's hot right now. So it's not like we're being rocket scientists here. We're just understanding supply and demand.
Right.
And by doing that, we get to make a lot of money.
That's right.
It's a
That's right.
thing.
Well, again, I know that, even going through COVID, this building seemed to be COVID proof. Like we still had 99% occupancy rate.
All the way through.
All the way through. And I think our only available units were for demo units and corporate rental, right? So it was kind of on purpose,
Yeah. So it's really one of those things where sometimes, once we solve with the real residents that live there, and listen, the great thing, if you think about the residents that live at our property, they're military, they're also hospital workers, and then there's still a little bit of that agriculture there, right? The workforce. They all had jobs. They were all employable. And so, so no one left. And, and so I think there's a lot of that all across the United States. There's pockets where it's a little bit bad, but all in all, like the real estate market overall is hard. Like there's not enough, there's more demand than there is supply. And that's going to keep our buildings rented for a long time.
Well, and I know that you do a tremendous job in your screening process of all the tenants. I know we've talked about that like in depth. So, again, that kind of goes to also the strength of the people that you're, renting out to as well. So, sorry.
Well, I was just going to say that's another good point. We've learned a long time ago that the more money, more rent you collect from tenants, the better quality tenant you get. So we want to raise rents as high as humanly possible because we also get a better tenant profile. They don't tend to tear up the property as much. They'll pay more. They'll stay more consistent, and they won't miss.
Yeah, which has been proven. So, all right, Corey. So lastly, before we wrap it up, like what I want to get into the, again, not a sales pitch for, anybody individually, but just, you're an educator. What advice would you give to an investor, whether they've been involved in syndications before, or they're just thinking about what to do with some money that they may have at this point, if syndication's right for them? What would you encourage them to do their due diligence when looking at an opportunity or evaluating even syndications is right for them?
Yeah, I'm going to say that one of the easiest ways for someone that's new to looking into is to vet the operator. So here's how you vet the operator. It's really not by what I say or what I do or for anybody that's out there, that operator can tell you anything, right? Vet their investors. In other words, have the operator give you 3 to 5 true referrals and you want one that's been there with them a long time, maybe someone in the middle, and someone that's kind of new. So that's 3 different perspectives, in my opinion, to vet and say, did he pay? And here's the questions you should ask is, how did it go? Did it go as planned?
Yeah.
Were there bumps in the road? Did he say he was going to do something and did they do it? Did they tell you that they were going to give financials and did they do it? You're looking for enough clues that, hey, there's a pretty consistent story. I think that's the easiest, best way to vet, and because most people are not going to really understand to look at an apartment deal and say, oh God, this is a great deal, right?
Yeah.
Or what it is. So you're kind of relying on the syndicator and they're all going to say it's great. Okay.
Right.
The best way is to get it from the people that invest with them. They'll tell you the truth because people's money doesn't lie. No one lies about money like when they're making it, right? Or they're losing it. They're going to let you know.
Yeah, exactly.
And so, and then also understand, we have this, COVID happened and we have some properties that didn't fare as well as the Palms. The Palms a great story, but we've got some property in New Orleans. New Orleans was hit hard by COVID. And so we've had some non-paying tenants, right, that understands the program and just didn't pay for a while. And then we had an eviction moratorium to where we couldn't even evict. So that property suffered a little bit more, got into the 80s, 85% occupancy. We had to postpone payments for a bit. But we're getting ready. We brought them back on last quarter, and we're fixing to make a full distribution this next quarter. But those are the questions, like, how did it happen? What, how was it communicated? Did the follow-up plan get executed correctly, the way it was envisioned? Right.
Right.
You're just looking for leadership, and I think that's what you should be asking, those types of questions to vet. Is this person going to do what they're saying to do? And then the last one, Gary, is, do they have a track record?
Right.
Show me not just your first deal that you've ever done. Show me like 4, 5, 6 of them.
Right. That's very important as well. And I think in all aspects of professionals who you hire to, to manage your wealth, in a sense, it's essentially what you're doing is wealth management in a slightly different fashion. It's just tied to real estate, right?
That's exactly what we do. Yep.
That's right. So, okay, Corey, I'm going to let you get back to your family and your vacation there. So thank you so much for joining us again. This has been incredible wealth of information and knowledge. So hopefully everybody, is benefiting from that. If there's any comments or whatnot, we're going to get back to it, but please leave your comments down below. Give us a call directly. Corey is always available. Not typically on his vacation, so I feel very blessed here, but afterwards, I'm sure he's happy to answer any questions for you. So again, Big Kahuna, thank you so much for joining us today and taking your time. Appreciate all the information. We'll be in touch very soon.
Thanks, brother.
All right, later on.